Over the last couple of years, since the COVID scare, this market in India has traded well above average mean valuations of the last 15-20 years. I mean, we are used to trading on an average at about 15 kind of P multiple. But we've been trading at, given whichever time you focus on, 18 to 20 kind of P multiple. Given this volatility risk ahead, do you see this market having the risk of going back to the average valuations of past years, which is about a 15 P multiple?
Then you have made a very, very important point that for a while we were trading way above our historical average valuation. And partly this was driven by very strong earnings growth which we witnessed, especially in 2021 and 22. Now going forward, interest rates are rising, inflation is rising, and earnings growth on this larger base is likely to slow down. With all three things together, should there be a marginal derating of Indian valuation going back to its historical valuation? It is quite likely. However, a lot will depend upon what happens in the inflation trajectory and interest rate movement globally. If you look at the base, the US Fed rate should go higher than what is priced by the market. If you look at US employment data or housing data. On the other hand, keeping in mind midterm elections and also the first quarter GDP number which came negative 1.4%, there is a small possibility that US Fed rate may not rise as much as discounted by the market. So to a great extent, how interest rates move and how earnings growth move will determine whether we will trade at recent valuation or revert back to our historical average valuation.
Nilesh, what is the likelihood, given all the ingredients or factors that we just touched upon, of a global recession coming sooner or later? Would you say that you're monitoring some of these factors very closely over the next few months? Do you feel the chances of it have receded, given perhaps, like you said, the Feds need to be a little bit more cautious on its aggressive stance? Or do you think we're going to see it regardless of timing, simply because the era of easy money cannot continue?
About the base case across most countries, including globe, seems to be of a slowing growth but not getting into recession. However, a lot depends upon how Russia-Ukraine situation develops. If there is an escalation which is not priced by the market today and it results into supply chain disruption and commodity price inflation, undoubtedly global growth can decelerate further from current levels. But at this point of time, looking at the current situation of commodities which have started correcting, and looking at the current situation in Russia and Ukraine, where war seems to be focused more, in certain areas rather than whole of the country, it looks like global growth will slow down, but certainly not to the extent of a recession.